Hello and welcome to the first video in our personal finance series. Today we're going to be going through a personal finance overview, just trying to hit a number of different categories that you're likely to come across throughout your life. So it's good to have a general awareness of this. This is really meant to be for beginners who are just looking for a broad awareness of what are the different things I'm going to need to know throughout my life and different personal finance topics. So that's really who this audience is meant for. Again, today we're just going to hit these at a very high level, and then in the future I'll be launching new videos to go through a deep dive of each one of these different topics. So with that, let's go ahead and jump into it. And again, the data for today is going to be all focused based on 2022's numbers. So some of the different categories we're going to hit today, we're going to talk about financial accounts, we're going to talk about cash flow, taxes and the different categories of taxes you'll typically have to pay. We'll go through some different investment and retirement accounts. We'll talk about Social Security as well as the meaning of your credit score, why it's important and how that's made up. And then last but not least, we'll talk about home and mortgage, which is something that everybody should hopefully encounter throughout their life. So before we jump into the different topics, it's important to get a good picture of where you are today. We'll look at two different metrics. We're going to look at your annual income, and then we're going to look at your net worth. So the way to read this chart, it's breaking down by age the different percentiles for income. And the way to interpret a percentile is, say, for example, you're in the 90th percentile. That means that 90% of people in the United States have a lower income than you, depending on the age that you're in. So for example, say you are a 35-year-old individual and you're currently making $50,000. You would look at this chart and say, okay, I'm in the orange bar. I make more than $28,000, so I'm better than the 25th percentile. Okay, looking at the 50th percentile, that's right around my income. So I would say that I make more money than 50% of people, and then 50% of people also make more money than me. But you can look at this and see where you are generally, but there's also a link down here below that I'll include in the description so you can see exactly where you fit based on your age and your exact income. And then we'll look at net worth. So there's another page in the future that I'll talk about in a couple slides that shows how to calculate your net worth. But this is basically all your assets minus all your liabilities, what that final number ends up being. And this is broken down similarly by different age ranges. You can see here, for example, say you're in the 45 to 49 range and you have a net worth of $450,000. That would put you at the 75th percentile for your age. And then there's also a calculator down here if you want to see specifically for your net worth and for your age range. So it's important to look at these two metrics and decide, where do you want to be? Are you comfortable with where you're at today, or do you need to make some changes to try to improve where you fall in that range? So the first topic we'll talk about are the different financial accounts that you likely already have today, just might not be aware of the different categories that they fall within. So one are your assets, and this is what you own. So things like liquid cash, maybe checkings or savings accounts, maybe you have cash in a safe at your house, that would be considered liquid cash. The equity in your home would be considered an asset. Any taxable investment accounts, so if you have a brokerage account, say with Ameritrade, where you can put money in and pull it out as needed without incurring any taxes or different penalties like you would with a retirement account, that would be considered an asset. Liability, so this is what you owe other people, so any debt you have on your credit cards, if you have an auto loan, if you have a mortgage loan, and then your retirement accounts. These are things that you're setting aside for further in the future that you're planning on not touching for a longer period of time. These typically would incur some type of penalty or fee to withdraw the money early, which typically in the U.S. is 59.5. These are things like a company-sponsored 401k plan, a Roth IRA, or an HSA account. And then that calculation I mentioned earlier, just calculating your net worth, you want to add together your assets plus your retirement accounts and then subtract out those different liabilities you might have. And then next I want to talk a little bit about cash flow. This is likely a term you've heard before, but maybe don't know all the different components that go into it and how it's calculated. But first you have your income. This is what you're earning, and we'll usually look at this on a monthly basis. You've got your retirement contributions. This is what you're setting aside for your future, and we also call this paying yourself first. And then you have taxes. Typically are hard to avoid as the government's cut, and you want to minimize this legally. So if you're doing your taxes today trying to save a few bucks, it might make sense to have a tax accountant who's going to find all the different things in the tax code that can help reduce your tax bill legally. Then you have your expenses, and this is usually broke down into what you're spending on a fixed basis as well as a variable basis. So your fixed expenses are going to be things like your mortgage, your utilities, your car loan, things that you have to pay every month regardless of what you're doing. It's usually in a fixed amount. Then you have your variable expenses, things like dining out, maybe going to a concert, going on vacation, things that you could cut out and really are not needs, but are rather wants. And then to calculate your cash flow, or you might also hear this called net income in personal finances, but it's your income minus your retirement contributions, minus your taxes, and minus all of your expenses. And that's how you get to your monthly cash flow. And on that topic of taxes, unfortunately, there are a wide variety of taxes you're going to have to pay throughout your life. Depending on whether you're a business owner or self-employed or an employee, it might be a little bit different. But most people are going to have to pay a federal income tax, and that tends to be the biggest one that you're paying. The way this is handled, if you look at the table on the right there, these are the 2022 tax brackets. In the United States, it's done on a graduated tax bracket basis. So the first $10,275 is going to be taxed at 10%. And then the next roughly $31,000 between $10,000 to $41,000 is going to be taxed at 12%, and so on. So let's say you earn $100,000, you're not going to have $100,000 taxed at 24%. You're actually going to have $10,000 taxed at 10%, $31,000 taxed at 12%, about $48,000 taxed at 22%, and only $11,000 of that's going to be taxed at 24%. So you might hear the term effective tax rate, and that's if you add all those up and divide it by your income. That's what you're actually paying. So for $100,000, it won't be 24%. It might be something more like 17 or 18%. Then you'll have your state tax, and this will be variable depending on the state that you live in. Some states don't have an income tax, like Florida, but this could be a graduated basis just like federal, depending on the state, or it could be a fixed bracket where regardless of how much money you earn, you pay, say, 5%. Then you'll have your city income taxes. It's going to be potentially a combination of where you work and where you live. So you're always going to pay taxes in the city that you work, and then your residence city sometime will recognize a portion of what you paid to your work city so that you're not being double taxed to the full extent, and then you'll pay the remainder to your residence city. And this is somewhere typically between 0 to 3%. And then Medicare, this is you paying into the government program for taking care of your medical insurance in retirement. Social Security, we'll talk about this in more detail later, but this is typically broken down if you're an employee into an employee contribution as well as an employer contribution, and this is for things like Social Security disability payments as well as your retirement, partial retirement by Social Security. Then you have property taxes, where you're going to have to pay a portion of your property's assessed value to the government every year, and it's typically done in 6-month increments. And then sales tax, there's certain items that are excluded from this, like food and certain other items, but for the most part, there's going to be a sales tax of somewhere between 5% and 10% on everything that you purchase. So if you sum all that together, a realistic total tax rate for someone with just a $50,000 income could be about 40% of their income before they actually have the money they can spend to buy goods and services. And this is excluding other things that you might be taxed on, like dividend taxes or capital gains taxes. And now on to everybody's typically favorite part is talking about investments in retirement. So we'll start by talking about some different investment types. Some you likely have heard before, but some others you might be less familiar with. So some different investment types. There's stocks, which are basically you're buying a portion of a company and you have the rights to all of their future earnings as long as you hold on to that stock. There's two different ways you can earn money on a stock. One is capital gains, and this is where the stock price actually appreciates, and you get to enjoy some of that appreciation in your own stock price. So let's say a stock is worth $100 when you buy it. In a year, it goes up to $110. You get to potentially, if you want to sell out of that stock, you could sell out and lock in that $10 gain per share that you own. And then there's also dividends, which companies will, larger companies typically will have these that are more established. Smaller companies may not have dividends just because they're still in that growth phase and they're reinvesting all their money into trying to grow their company's revenues and earnings. But a dividend typically is paid out on a quarterly basis, so 4 times a year. A typical dividend might be something like 2.5%, 3%, somewhere in that range. So it's not a massive amount of money, but one benefit of that is that dividends are taxed at a lower rate than typical ordinary income. You probably heard of bonds. So there's a wide array of bonds. I'm not going to hit on all of them here, but it could be bonds from a company selling debt so that they can reinvest in their products in their company. It might be treasury bills that are sold by the government so that the government can fund its operations. There's a wide array. There can be local municipality ones as well. Certain ones have different tax advantages as well. But what you'll hear here, two important terms are the coupon and the maturity of this. The coupon is what the actual interest rate is that you're getting on that bond. So if the coupon rate is 2% and you bought a $100 bond, then every year it's going to give you back $2 in income. And then the other part of it is the maturity date. So if you bought a 5-year bond, then at the end of that 5 years, you'll collect interest throughout the entire life of the bond that you have it. And then the maturity, you'll actually get your original $100 back as well. So as long as you're willing to hold on to the bond throughout the whole life and the company or whoever it is that sold you the bond doesn't go belly up, then there's really no or little risk as compared with stock investing. Then you have mutual funds, which these are actively managed baskets of typically stocks, but it could also be other things that they're investing. They could be investing in commodities, it could be investing in bonds, it could be other things. But typically there's a team of investors that are managing your money and a number of other investors' money, and they're trying to get you a better return than if you just invested in the stock market as a whole or the bond market as a whole. And then there's ETFs, which this is also a big basket of stocks. It's a good way to get diversification fairly cheap. But this is passive management, where an ETF is usually tracking some type of index. So these tend to have lower fees than mutual funds. And there's option investing. This one is a little bit more complex, so I can't go into too much detail on this video. I'll save that for a future video. But two terms you'll hear are the strike price and the expiration date. The strike price is basically at what price your option is allowing you to either sell the stock of a company or to buy the stock of a company. And there's two different ways you can play it. If you think the company is going to go up in value, you would buy a call option. If you think the company is going to go down in value, you would buy a put option. And then the expiration date is how long you have the option to buy the company at that strike price. And then there's real estate, something you're probably more familiar with. So purchasing homes or rentals or commercial real estate. And then something that's fairly new relative to the others and that's getting more traction in recent years is the cryptocurrency space. And within cryptocurrency, there's actually 10 or so different channels or verticals that you could invest in that are focused on different things and providing different value or different applications. And we'll also cover those in a different video in the future. And then on the other side, the right-hand side, is the actual accounts that you're using to invest in these different products. So some of these are tax advantage or have other advantages, so we'll talk a little bit about those. The first of which is a taxable brokerage account. These have no contribution limits for how much money you can put into them, and the reason for that is there is no tax advantage to these. Anything that you earn on a given year, assuming that you actually sold out of the stocks and realized those earnings, that's all going to be taxable as ordinary income throughout the year. But there is a little bit of a stipulation. If you hold the stock longer than 1 year, it's considered a long-term gain and it's taxed at a lower rate. But if it's a short-term gain within 1 year, it's taxed at your ordinary income level or your ordinary income brackets. 401k, these are usually company-sponsored plans. These ones, you can actually have two different methods now. Becoming more and more common is a Roth 401k. Historically, there was just traditional 401ks. For the traditional side, this is where you're putting in money that's pre-tax. So you put in money before it's being taxed. It grows throughout your career. And then when you pull money out of it, it's going to be taxed. All the earnings, all the contributions, all the money is going to be taxed as ordinary income as you pull it out. If you had a Roth 401k, on the other hand, this time you're taxing the money and then you're putting in those tax dollars. It grows throughout your career just like a traditional 401k does. But then when you pull the money out, everything's considered tax-free. The principal contributions you made are tax-free, as well as all the earnings that you put in tax-free. So there's different arguments for why you would do one versus the other. I personally prefer the Roth 401k, but that's something that you need to discuss with your financial advisor, what makes the most sense for you. And then and that one has a $20,500 limit as of 2022 per year. And then you have IRAs. These are individual retirement accounts. You can do traditional or Roth in these just like you could with the 401ks. There are different advantages and rules around these as well, depending on which one you decide to go with. But both of them, as a combined limit for the year, have a $6,000 limit. So you can put $3,000 into a traditional IRA and another $3,000 into a Roth IRA. There's things such as a SEP IRA. This one has a 25% limit that you can actually put in, so 25% of your actual income. And an HSA, so this is a health savings account. This is you putting in pre-tax dollars so that you can pay for medical expenses. And unlike other medical plans, maybe like a FSA, a flexible spending account, where the money disappears at the end of the year if you don't spend it, this stays with you for your entire life. So any money you put in here, it's actually triple advantage because you can put in pre-tax dollars, it grows, and then whenever you pull money out of it, as long as it's for qualified medical expenses or after a certain age you can pull it out for any reason, the principal and the earnings are all considered tax-free. So that's a unique advantage of an HSA. And then you have a 529 plan. This also has good tax benefits, but it has a $16,000 limit per year because the contributions are considered a gift for federal tax purposes, which is currently limited at $16,000 a year. But this is money you're putting away for a college fund or education in general that you can use it for. It could be for yourself. It could be for a child, a grandchild. But this is money that you put in pre-tax. It grows, and then as long as you spend it on qualified educational expenses, all that money is going to be considered tax-free when you pull it out as well. And then the next one I wanted to talk about was Social Security benefits, and I'm going to focus specifically on the retirement contributions, or retirement portion of Social Security. So this is a government program, and it's intended to partially replace your income in your retirement years. It's not intended to be fully replacing your income, and you'll see that down a little bit lower. So this is funded throughout your career. If you're an employee, you and your employer are both putting in about 6.2% of your income in each paycheck, and this is limited or capped up at $147,000 in annual earnings. But if you're self-employed, you'll probably have heard of paying a self-employment tax. That's what a majority of that self-employment tax is. You're paying the 6.2% for yourself, and then you're paying the 6.2% as being the employer as well. And you do get a little bit of a tax deduction for that as well. So it's not a full one-to-one increase in your Social Security contributions. And the way they decide how much they're going to pay you whenever you reach retirement age is they're going to look at your top 35 years of indexed earnings. And what I mean by index here is they're going to look at all the inflation that's happened year over year for each one of those years of earnings. So say you earned $50,000 in 2020, Well, we're now in 2022, so they're going to index that, say, by 2% the first year, then 2.5%, and then 2%, just depending on whatever inflation was for each of those years to get you in a normalized, adjusted earnings for current day's dollars. And then how collection works is you can either take, and as of today, this is always subject to change. You might have heard that Social Security is underwater, they're underfunded. And these roles are definitely subject to change as lifespans go further on and as less people are contributing into Social Security just based on age demographics. But as of now, it's 70% of your Social Security benefit you can collect at age 62 and then continue to collect until as long as you live. And then you could also wait until you're 67 years old, and you can collect 100% of that benefit. And just to the point of, hey, this is a partial replacement of your income in retirement, the average Social Security check in 2022 was about $1,600 a month, or annualized about $20,000 a year. So this is not something that is intended to completely fund your retirement, so you definitely need to make sure throughout your career you're setting aside other money, whether it's a 401k, an IRA, other investments, so that you can have a comfortable retirement. Then I want to talk a little bit about credit scores. This is something probably people don't think about too much, but it could have a huge impact on how much you pay whenever you borrow money for different reasons throughout your life. And what that credit score tells the lending institution, so banks or credit card companies, is how reliable of a borrower you are. And the reason it's important is it defines or determines how much they're going to let you borrow and at what interest rate they're going to lend that money to you. The range of scores that you can have are anywhere from 300 to 850, 850 being the best. And there's a number of factors that go into calculating your credit score. The most important is your payment history. So have you ever made a late payment or just completely skipped a payment for whatever reason? That's the biggest component of your score. And then they'll look at the amounts that you owe. So do you have a ton of different credit cards that are racked up to the max? Or are you doing pretty good as far as your credit utilization? So how much you're actually using versus how much you have available to you. They'll look at the history length. So the longer you have established credit, the better. They'll look at your credit mix. So are you just all credit cards, or do you have maybe student loans as well? Do you have a mortgage? A mix is better than only having one type. And then they'll look at new credit. So if you just pulled out a bunch of new debt, that's going to ding your score a little bit. It's only 10% of the calculation. Just look at a quick example scenario. If you purchased a $300,000 home, or you had a $300,000 mortgage at a 30-year fixed rate, if you had a great credit score, you might have got a 3% rate. And when you pay back that full loan over the 30 years, you would have paid a total of $455,000. But if you had a poor credit score, say 600, and you got a 4% rate, you would have paid an additional $60,000 in interest. So knowing your credit score and working on improving it has a massive impact on your life and how much you spend on these borrowing products. And last but not least, we'll talk about home and mortgage. You may have heard the wisdom before that owning your home is really the first step towards generating wealth in your life. You're getting equity as you pay down that mortgage, and you're also enjoying any appreciation in home prices as long as you own your home. So it is a great piece of advice, but there's some different terms you're going to need to understand as you're going through that home buying process, especially for the first time. One of the things that you're going to need to be aware of is a loan estimate. And this is the official form that's required to disclose all the different costs associated with your loan, the rates, the terms, the payback period, if there's any balloon payment required, all the fees you're going to have to pay to the real estate agents, to the title agency. There's all these different closing costs that you're going to end up having to pay, and it's better to be aware of them going into the process as opposed to being surprised whenever you get to closing time. So you're going to want to get this official form, and the great thing about it is it's a specified format. It looks identical whether Morgan Stanley gave it to you or if Ally Financial gave it to you. So you want to get multiple different estimates from these banks, compare them line by line, and then choose the best one for you to go with. So part of that is going to be the loan term. Most people go with a 15 or 30-year loan. The longer the loan period, the lower your rate will be. It won't be significant, but it will be some amount lower if you go with the longer loan. The reason for that is banks can make more money if you're dragging out this loan over a longer period of time. It's going to result in much more interest that they're going to be able to earn on your loan. And then the rate type, you'll hear fixed versus variable. Variable just means that it can change anytime in the future. It's usually tied to some type of benchmark interest rate plus some margin for the bank to earn on top of that. But for taking that risk that it may go up in the future, if the benchmark goes up, your loan's going to go up. You'll get a lower rate now. In some of these, you might hear ARM, ARM. It's an adjustable rate mortgage. But it also might be like a 5-year ARM or a 7-year ARM, where for the first 5 years, the first 7 years, it's locked. And then after that, it can move along with that index benchmark rate. The down payment, this is going to be likely the biggest cost of your loan, and this is going to be the portion that's due at closing as a percentage of the loan. So if you're pulling out a $300,000 loan, you're putting 3% down, that'll be $9,000 right there. It's typically 3 to 3.5% is the minimum you're allowed to put down, depending on the type of loan you're doing, if it's FHA or conventional, but we won't cover those details now. And then you also need to consider private mortgage insurance, or PMI. So if you put down less than 20%, the bank wants to have some type of insurance that if you decide not to pay the loan because you don't have that much skin in the game, that they're going to be able to recoup their cost. So if I lent you $300,000, you only put 9% down. That means you have $9,000 down, or sorry, 3% down. You only put $9,000, but the bank put $291,000. So they want you to buy this private mortgage insurance. So if you decide to not pay your loan anymore, that they're able to recoup the difference in case they're not able to foreclose on you and sell your home to get back their $291,000. You might have heard the term points. These are fees paid up front to reduce your interest rate. You'll hear buying points. 1 point is usually 0.25% of the loan. So if your original loan was 3%, you bought 1 point, it would be down to 2.75%. And these points usually cost 1% of the mortgage. So sticking with that $300,000 mortgage, if you bought 1 point, you'd have to pay $3,000 to reduce it by 0.25 point. And there's usually a payback calculation where, depending on how long you're going to live in the home, are you going to be able to recoup that $3,000? So let's say it brought your mortgage payment down from $1,900 to $1,800. It's going to take you 30 months to repay that $3,000 that you paid to reduce your interest rate. So it's a calculation that you need to be aware of. And then your monthly payment, don't just look at the principal plus interest, because there's also property taxes, there's also home insurance, there's also potentially PMI, there's also potentially HOA fees. So when you're trying to determine if you can afford the home that you're looking at, you need to include all the costs and not just the mortgage costs. So I hope now you feel like you've got like a good overview of these different personal finance topics that you're going to come across likely at some point in your life. And again, I'm going to go into deeper detail on each one of these. Each one of these you could write a book on, you could study for 10 years in school. So there really is a lot underneath of each of these high-level buckets that I covered. But if you did enjoy this video and you got value from it, please go ahead and hit the like button. And if you subscribe, you'll be notified whenever I do come out with those future videos. And then if you think someone else in your life might get value from this video and the future videos that I'll be launching, please go ahead and share it with them as well. I would greatly appreciate it. All right, thanks again for watching, and I'll see you on the next one.